Good afternoon, Campbell McCreary here, Amvest Capital in New York City. Welcome to the Amvest Capital Inc. live webinar with Electric Royalties Limited. Electric trades on the TSXV as ELEC and as ELECF on the OTC. Hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in, and we'll ask the questions for you in real time. That's a big component, is sending in questions in our format. This event will be available about an hour after we wrap up at amvestcapital.com/replays. You can also get it in an email. Amvest, of course, is a New York-based specialist investment management corporate finance firm solely on the natural resource sector. Please note this call is for informational purposes only. Please read this disclaimer carefully. Very pleased to have with us today Brendan Urich, who is the CEO and director of the company. Brendan, I'm going to make you presenter. He's got a substantial financial advisory background. He's raised over or been involved with alternative financings, debt, and M&A, over $2 billion of transactions in the mining space. And before that, he was a research analyst in the mining space as well, and worked with some great companies, including Endeavor Financial, Cambrian Mining, Northern Vertex, and King and Bay West Management. And again, please send in your questions, and please share your feedback on your way out in the question thing there. And Brendan, if you want to turn on your webcam, it's all yours.
Perfect. Okay.
Good. Yep.
Hello, everybody. Thanks for that introduction. Our company is Electric Royalties. We are a royalty company. We're the only royalty company out there focused exclusively on the entire suite of metals really required for the transition to clean energy. A lot of people talk about batteries, they talk about electric vehicles. That's definitely part of it. A big part of it, but it's also energy storage. The energy storage business at Tesla is going to dwarf their car business in the not too distant future. It's renewable energy. Which requires, wind, for example, requires a lot of zinc. Needless to say, there's going to be a very big metal demand really across the board, as we rebuild the world's global infrastructure towards a decarbonized global economy. And it's really exciting because it's really the first time, in human history where you've had such a big wave of demands that are going to hit so many different metal markets all at once, most of which are, have been fairly small. As we move forward here. So, I won't spend too much time on this. I think everybody kind of agrees at this point that, we need to pursue this drive to electrification. But, the really interesting thing, this chart at the bottom here was actually put up by Glencore about 6 months ago. And, what I like about this kind of shows what we're replacing and phasing out over the next kind of 10, 20, 30 years. And a lot of people might have trouble wrapping their heads around it, but essentially manganese and cobalt and zinc and these various metals, these are the, oil fields of the future, these deposits, as it were. And when you think about how much capital has gone into the oil and gas sector, on an annual basis to make sure the world's energy needs are met, it's been about half a penny, goes into the battery metal space for every $100 that goes into the oil and gas space. So you've got a very big period of underinvestment in this space. So you got very thin supply pipelines across the board, and on the other side, you have this kind of exponential growth forecast. So, I won't spend too much time on these again, but, I just like to highlight that, we haven't even gotten started. This is just the very beginning. You see where metal prices have already, started to take off, and, we're at day one, with 2 decades runway ahead of us. So, I think we're kind of early in the space, it's an exciting time to definitely be in this space. Again, right, talk about electric vehicle sales, we're at day one, relative to where we're expected to be over the next kind of 10, 20 years. It's interesting to note that, even in this political climate, where it'd be very difficult for a lot of these countries listed below to agree on anything, the one thing they all do agree on is that we need to make this transition to clean energy. And so, stuff that might have been crazy 10 years ago, like India and France and the UK, all banning the sale of petrol cars in the next 10, 15 years. The US, they just came out with their $2 trillion infrastructure program, and they're building 500,000 public charging stations by 2035. So it's definitely a global, push, and something that is going to have a very big impact, like I said, on metal demand for a lot of different metals. This chart's just kind of a good infographic to kind of help show you where each of these metals plays a part. And by and large, a lot of these metals are key across several aspects of this, whether it's electric vehicles, solar, wind, carbon capture, or energy storage. Each of these metals really plays a pivotal role towards our future and what the world's going to look like. This again, it just kind of gives you a little bit of kind of key details on some of these different commodities that we're chasing. Our approach really, quite frankly, is to not try to make a bet in terms of where battery chemistries are going to go, which new technologies might come to the fore and provide supply side disruption risk. Each of these commodities that we chase, they all have exponential growth forecasts. Now, ultimately, one or two of these might get replaced. Cobalt has been one that's been, on the radar for people for a while. It's the highest cost input, but our approach is really to stay diversified across each of these commodities, provide exposure, equally to all of them. And in that way, we're more generally playing the trend of this, green revolution as we move forward. And, even if we lose one or two along the way, you have exponential growth on the rest of them. And it's a, much safer way to kind of, play this space. This is just kind of a good chart, showing the metal demand, resultant over the next kind of 10, 15, 20 years. Again, this one at the bottom was actually put out by Glencore. I think it's just interesting to note that, for all the attention the copper gets, the actual relative growth rates of cobalt, nickel, and zinc that are required as we move forward, they're all higher than copper. What people don't understand, I think what maybe people outside the sector have misunderstood, is that it's a very long development timeline to get a mine into production. So if you have this huge period of underinvestment for the last 15 years, 20 years, pretty much forever, you have a very thin supply pipeline. If you tell me you need a new tin project today, right? You need tin today. I go put a drill hole down. Great, we found some tin. I might actually be able to produce you some tin 10, 15 years from now, because that's really about the average development timeline. So there's not really any way that you can kind of make up for that lack of period of underinvestment. And ultimately, we believe this is going to translate into higher prices. You have, supply deficits forecast really across all these metals within the next 5 years. So, I think everybody agrees, like, this is a great space to be in. You've got, very good growth looking forward. And, there's definitely a long-term and sizable opportunity there that, is really kind of the first time in human history, like I said, that you've seen something like this. Now, the other aspect of it is how do you, really get exposure to assets and play this? And, for us, it was very simple. We wanted to be a royalty company. There's a lot of benefits to a royalty company. Start with the similarities first between, an average mining company that would operate a project versus a royalty company. Look, we both get exposure to commodity prices, exploration upside, production rate upside. Thankfully, that's kind of where the, similarities end, right? I mean, we have no holding costs, right? It costs us absolutely nothing to hold these royalties. We put up our upfront capital, and that's it. It costs us nothing to hold. We are not on the hook for development costs, capital costs to actually build the project, cost overruns, none of that, right? That is all funded by the operator out of their own pocket, and at no dilution to us. If you look at, a great example would be the last 12 months, operators of projects that we hold royalties on have raised and invested about $100 million, right? And if we were to do that ourselves and had to spend that money ourselves developing these assets along, that would have been a 300, 400% dilution for us. And, instead it costs no dilution. So, definitely a very key, piece of this. I'll just touch on a few other points, but, the nice thing is you don't need to build out a big team, right? I remember, a very small mine, might have to employ 50 to 75 people full time just to get a very small mine up and running, and you might have a 50 million, 100 million market cap, relative to Franco-Nevada, which is one of the biggest royalty groups out there. They're 25 billion market cap, and I think they've got about 25 people working there. So, you don't really need to build out a big team. So this way, through this model, we're actually allowed to stay diversified, not only across all these commodities with great growth forecasts, but also across, various different assets as well. And so, it's a much lower risk way to play the space, diversifies our investment risk as well. The one last thing I'll note is that, royalty companies and royalties, we're dealing in pretty good jurisdictions. I mean, we are targeting good jurisdictions, and they've got good mining codes, good for frameworks for regulatory, and we can actually tie our royalty to the project. So, let's say management takes on debt at the wrong time, or, things don't work out for whatever reason, and they lose the project, our royalty actually sticks to that project. And so whoever inherits it afterwards is still gonna have to honor that and pay our royalty. So, you also get a little bit of, kind of protection as well. Lots of different ways you can create royalties and consolidate existing royalties. We tend to focus on creating new royalties, where we can. I mean, we're opportunistic on consolidating existing royalties, but when you create new royalties, you get to draft the agreement. We really like to stick to gross revenue royalties. It's right across the top. You're usually helping out in a pinch, where somebody actually needs that capital. So, it usually translates into better deal terms, and ultimately, it covers the whole project, right? So, if you wanted to get paid, the mine's going to be in production for 70 years, you want to make sure that you're going to get paid for 70 years. So, we tend to be, a group that has that experience of going out there and creating new royalties. But like I said, we are opportunistic as well, consolidating existing ones that are out there. So to date, we've got really 16 royalties in the portfolio. We actually just closed this morning, thankfully, on our first cash flowing royalty. This was a $17.5 million deal, thereabouts. We managed to bring in Sprott Royalty and Streaming, which is a pretty well-known name in the space, to come in and put up 13.5 million cash alongside of us, and to close that royalty out. And so we're excited. I mean, this is, it's in the US. It's vertically integrated, really with the only primary zinc producer in the US. It's had a long history, right? It's been operating for 30 years. We expect it'll be producing for decades in the future. And it's got Trafigura as an operator. Very big group. Can't remember exactly what their revenues were last there, but it was in the hundreds of billions. So, you got a fantastic operator with, capital to spend and, great location. So we're really excited. We just closed that out this morning. We've got a very good lithium royalty portfolio that we're building up. Our flagship royalty would be the Oche Lithium royalty. It's operated by Sayona Mining. Sayona Mining actually has, they just closed a 50 million financing, a few weeks back, as part of their acquisition of the Canada Lithium mine. Canada Lithium mine is the only producing lithium mine in Canada, as crazy as that sounds. And basically this Oche project is right next door. And so their plan is to blend the ore from the Oche project at the Canada Lithium mine. And we're actually on track to see that kind of in production, over the next kind of 12, 18 months. So that'll be exciting. We've also got a lot of other hard rock lithium royalties on advanced projects, in Eastern Canada, Quebec and Ontario. The Seymour Lake royalty, I mean, that's under a joint venture that just recently was signed. They're moving that forward. It looks kind of like what Oche did a few years ago. We got drilling going on at Chubb. And so, an exciting, package of lithium royalties in Eastern Canada. We've also got our key manganese royalties here. We're really excited about this. Our Battery Hill royalty is definitely the flagship. There's only one district really in all of North America that actually is developing a project to supply manganese for the EV space. One district. All of North America, we've got royalties on, basically 2/3 of that. Battery Hill is going to be the big piece of that. And right now they're undergoing a PEA. Might make it sound like it's a little bit earlier than it is. These guys are very advanced on metallurgy, much closer to the the feasibility stage level on metallurgy, which is, across battery metals projects, probably the biggest, import. And so, that project, as the only district really in North America, we're excited for people to see the economics around that. I don't think we're getting much value for it today, but we're expecting, right now, that'll be our biggest royalty once in production. We're kind of forecasting 5 to 6 million a year, 35, 40-year mine life. So, on top of that, we've got our flagship vanadium royalty, Mont-Saucier. This actually has Glencore recently brought in as a partner. It's probably the best iron ore development project, I would say, in all of North America. Vanadium being a great byproduct of that. And they've actually just doubled the resource, about a month ago as well. So, a lot of work being done on that. We're excited for that to move forward. We were already expecting, somewhere in $1.5 million a year range once in production, and 38, 40-year mine life. So we'll see what happens when they, what they do with that double sized resource. But that's very exciting. We've also got a great portfolio of graphite royalties. Biscuit Creek is, about construction ready as you get. It's 15 kilometers away from the largest gigafactory under construction in the US. Feasibility stage, ready to go. We've got Graph Mata. This is a royalty that we are expecting to close on finally soon. Part of our first, deal that we've done with our new partners at Vox Royalties. Precious metals focused royalty group that has some proprietary database, information in terms of existing royalties out there. And so we partnered up with them on this. This is exciting. It's only the operator is one of 2 groups on the ASX that's actually capable of producing graphite. They've done 18 months run and had all of their product qualified. For those who don't understand the graphite space, and it is evolving, that's a very important milestone. It's much different than, say a copper mine. You have to go through that critical phase of producing enough graphite that you can get it vetted by offtake partners. So we're excited about that. And as part of that package deal, we're also picking up the Albar graphite royalty. It's a bit earlier stage, but high grade graphite resource in Australia. And then we've got a nice exciting package of cobalt royalties, cobalt copper royalties in Australia. Millennium Cobalt actually being advanced by a recently signed JV. They should be drilling on it actually this month. So, lots going on. That's kind of where we're at in terms of our portfolio. I'll just kind of push ahead to our cap structure and then, kind of maybe open it up for questions. But, essentially, and this changed this morning. So, we're probably, I think we're about a 27 million company now. We had to issue 9 million shares of electric royalties out as part of that closing this morning. But we got no debt. We've got over 3 million cash in the bank. All in, fully diluted, we're close to about 70 million shares. Myself and my family, very large shareholders in the company. We own about 15%. Board of management on top of that, probably has another 5 or 10%. And then, we've got some good institutional investors, groups like Commodities Capital, Pathfinder Asset Management, and then a really large, bulk of high net worth individuals. Guys like Ian Telfer and Paul Matisek and, David Elliott from Haywood, and a very, good group of guys. So it's, very tightly held, and really just starting to get going here. We went public in the middle of COVID last year. It was kind of an exciting, exciting time to try and do that. It took us a few months longer to kind of get off the ground than planned, but successfully did that. Closed on our kind of all the initial royalties we'd signed up privately, and just kind of moving fast and furious now. Just got our feet under us really, I would say, kind of January of this year. But definitely an exciting time to be a shareholder, and look forward to showing everybody what's next. I'll maybe pass it off to you, Campbell.
Okay, bear with me. Please send in your questions. We've got a few, and we've got a few, but now's your chance to get to know the story. I'll just gonna kick it off a little early. You're just kind of out of the gate here, but do you plan to make yourself attractive to be acquired, or might you be a consolidator? What?
Yeah, well, look, I mean, I'd like to be a consolidator. I mean, right now, let's take this Vox transaction, for example. We just have different focuses. If you look at where most royalty groups are, they are primarily precious metals, like, across the board. There are, a few groups. Nova Royalty does copper and nickel, primarily does only consolidating existing royalties. There's Lithium Royalty Corp. They're privately held. They only do lithium, and so there's, a couple groups out there, that are kind of playing one or two of these commodities. But there's no groups out there, quite like us. But by and large, a lot of those groups, we're looking to kind of consolidate their royalties from them, maybe eliminate a, potential future competitor. Look, I think there's lots of groups that are going to have interest in us, as we go forward. I would rather be the consolidator. But these are really the future, of metals. I don't want to talk anything bad about gold or anything, like that. But the growth rates expected across these metals, and the real needs that the world's going to have for these metals as we move forward. I think that it's only going to increase the attractiveness of other people and other groups wanting to get in our space. But right now we're happy to, just be plugging along and picking up a lot of, great royalties before people, know what's going on.
And so how will you pay for that? And how do you will you take on debt now that you'll have some cash flow? Are you going to sort of have a regular financing moment?
Yeah, so look, I mean, we've always been pretty creative about how we've done deals. Especially when we got started, we didn't have a whole lot of capital in the bank, and so we wanted to really be able to stretch those dollars and build it out. And I don't know if there's a record book for it, but I think we put together a portfolio, with an NPV on the royalty cash flows that's over $100 million. We've only spent about $3.5–4 million bucks in cash. So that's done by a combination of things. Partially, we got in our first royalties. We got in at very early time and at a very good price. We were kind of a year and a half ahead of everybody. And a lot of those royalties are being steadily advanced on, but that's just kind of part of the benefit of the royalty model. But we've brought in co-investors, right? So we brought in Sprott on our last deal. They put up 100% of the cash, right? We put down the $250,000 down payment initially when we signed that deal, but they put up the rest of the $13.5 million to close it. We kind of got our piece of the pie, by offering ownership in the company, as a way for them to have continued interest. So, that's one option. Look, we are talking about acquisition facilities. I would like to have one. There definitely are deals out there that we can go do. We've got a very big pipeline. You got to think about it that for a lot of these commodities, we're the only group out there. If they want to do royalty financing, for graphite or tin, there's only one group in town that's going to get excited about that right now, and that's us. So, there's definitely lots of opportunities. Debt, we're going to do that at some point in the future. It's a great way to, leverage, your cash flows and not dilute as you grow. I think we're going to wait until we have about 5 assets that are producing, so revenues spread across, a number of assets before we decide to take that on. That's just, I've dealt with debt before. I've advised on debt financing before. I just feel more comfortable that, hey, we're not risking anything. If we had diversified cash flow from, various different sources. But that's something that we'll look at. And, ultimately, I think there's a lot of deals out there where, groups are willing to vend royalties in to receive ownership in what we're doing. And so, there's a lot of opportunities for us to use our share capital as a way to grow. But, ultimately, you do have to raise equity every now and then. So I would expect that we'll, be doing that on a, fairly regular basis, as we move forward.
Got it. As much as you feel comfortable commenting, maybe a lot of people know a high-profile name, Kobold, the Bill Gates vehicle there. Any thoughts or anything to learn from what they're doing? Or
well, look, I mean, I've had quite a few discussions actually with groups operating AIs, for exploration. I mean, ultimately, we kind of had to look at it because it was kind of like, for example, there's only really one tin project, in the US. There's one in Canada. It's like, well, we've got a royalty on that. Then what do we do next? And you're going to need, the world's going to need more tin. So, we have looked at stuff like that, that's assisting in exploration, and trying to generate projects. Personally, like I know that camp, it's a lot of very narrow things, right? You hit these kind of narrow, high grade cobalt. But if I was going to be running an AI company and testing that out, probably not the camp I would have, tried that on. I would have tried it on like a big base metal system where something like that might be easier to try and pin down. But look, I think it's interesting. I think it's a sign of, generally something that everyone's going to have to be aware that, like, the mining sector hasn't received much capital, over the last, call it 10, 20 years. Battery metal space even less so. You've got a lot of big players like Bill Gates coming in now, funding technologies on the lithium processing, extraction side. Just saw they signed a antimony, agreement for batteries just, I think it was just this week. And so there's all those guys have more money than, the entire sector's seen over the last 10, 20 years. So, Schlumberger New Energy, very historically big oil group, also coming in on the lithium processing side. So it's going to be very interesting. You're going to see a lot more money and tech money coming into the space. And I think, tech can only help. I think technology can only help us. And it's going to be interesting. So
the junior market can't operate just by itself in a bubble. You need the big fish on top too. Moving on, I've got a few questions, and then Adam's got a few. So of the battery metals, which one or two are of the most concern in supply terms with respect to holding up a move towards volume manufacturing for the whole sector?
Yeah, it's a good question. I mean, ultimately, I think there's going to be supply issues across most of them. I think I would say on the opposite side, lithium probably has the most potential for big supply side disruption risk to a positive effect. There's a lot of lithium out there right now that's not being really, looked at. There's a lot of lithium in Nevada. Nobody's ever commercially extracted lithium from clays before, but there's a ton of groups that are figuring it out, and there's some big deposits down there. There's groups now that are looking at geothermal. I love that aspect of it. It's from an ESG point of view, it's just perfect, right? You're creating renewable energy at the same time as you're extracting lithium. But look, tin. I think tin is probably one of the big ones out there. I mean, there's not very many tin projects out there globally that could fill the gap. And when we did our analysis, we figured if you put them all the ones outside of China, you put them all into production, you don't meet where demand is 5 years from now. And that'll never happen. You can't, put every advanced development project out there. But these are all, relatively small things. They can't even be ramped up. It's not even like, oh, let's add some more people at it and it'll boost production. Just the way that the mining type and the deposit type, they're only ever going to produce kind of 1,500, 2,500 tons of tin, a year. So, tin is definitely a very interesting one. I think zinc is probably one that's overlooked, in a big way. It's kind of very thin supply pipeline. It's always been kind of copper's unloved cousin, I call it, but just nobody really paying attention. But it's a very critical metal. That we use.
My friend at Alpha Min Resources, Marit Smith, he calls it the underappreciated, the unloved critical metal. So
yeah, well, exactly. No, look, it's used in a lot of things. And so there's, they're all exciting though. I think, the fact is for manganese, there's only really one group in Australia with a manganese, deposit being advanced for the EV space. There's one group in Europe, and it's a more of a tailings remediation operation. There's one group in Botswana, and that's kind of it. Our group in Manganese X up in North America. But I haven't seen too many districts out there like that. Historically, 99% of manganese sulfate metal has been produced out of China, like as of last year. So that's definitely an interesting one to watch. I think nickel's got some good opportunities, some big deposits out there that a bit on the lower grade side, and seem to be a lot more discoveries. But the number of really advanced stage nickel projects that kind of fit the gap are again very small. So it's going to be very interesting to see how things play out. I mean, ultimately, I think you're going to need all of the metals that we can produce across all these different commodities and all the various technologies that we come up with that use them to really make this transition work globally. So it's going to be interesting.
Will you to that effort, why no copper royalties?
Oh, we're gonna go get some copper royalties. Like it's definitely on a priority. The nice thing about chasing 9 different commodities is that there's always ones that investor interest wanes on for whatever reason, and we feel like we have a much longer term view. So there's opportunities to pick things up a little bit cheaper. Copper's been such a hot commodity over the last little bit that just didn't make sense to go after when we were that small. You want to get the best assets. We're kind of approaching that size now where we can really bite our teeth into something. And I think we're going to try and make a stab at something producing copper. But look, I do love copper. Copper is a great metal and definitely something that we're going to be, targeting, picking up and fixing our lack of exposure to relatively soon.
Okay. Are you, for every deal you sign, how many do you look at and decline? And why do you decline things that cross your desk?
Yeah, well, I'd say that, the biggest reason why we, probably kill stuff off is quite frankly jurisdiction risk right away. Primarily we're looking to operate in, North America, Australia, and Europe. We want to find the projects that could be that domestic source of supply. And ultimately that stems from a few things. Mining's a risky game as it is. You take on jurisdictional risk when you don't have to. Places like the DRC, where you also have kind of ESG issues that crop up. It's just really not worth it, quite frankly. We had a number of clients back when I was in Denver Financial, where you had your camp got stormed by rebels one day and you had nothing to do about it, right? And so, that kind of experience, jurisdiction is definitely important for us. We do probably look at, for every 10, 15 deals, we probably choose one. The fact of the matter is, though, that we're not really as, takers of deals as we are, we know which assets we want. We already did an analysis on the pipelines across all these commodities, so we know what we want to go get. And we initiate those discussions, based on kind of where we're at in terms of the risk level, our current exposure, et cetera. But, the very first thing we did before we started this off was spend about 4 months looking through every single project across each of these commodities. And so that's the kind of, we look at it a little bit differently. It's not so much as, what comes to us. A lot of stuff comes to us and, it's pretty easy to go, yes, we want it, or, no, we don't. But it's more about, for us, picking out the right projects, quite frankly.
Okay. Uranium, or that's not in the mandate?
Well, look, there's a lot of uranium bulls out there. I'm not necessarily one of them. Like, I do understand the potential, for clean energy, and I think it's better than some of the alternatives. Stuff though with how long you have to store it afterwards, and it's not a perfect solution, right? Let's say that. For me, it's more almost economically, and just you see how many plants have been under construction for so long, how many actually finish. And there was I forget, it was like $8 billion construction in the US. They canceled it after that much. Just ain't gonna work. I think that for me is a big kind of aspect to it, but it just doesn't seem to have that global kind of incentivized. People just don't seem thrilled about the world going nuclear, and so it's a bit different. I'm not saying that we won't get into it. It definitely could be one of the commodities that you add to the mix. It's just a little bit different, if you know what I mean.
Yeah, there's a lot of ways to play uranium. That's well covered. Adam Graff, you want to take it from here?
Sure, thanks, Campbell. And Brendan, congratulations on the acquisition. Can you guys hear me okay?
Yes.
Yeah, no, thanks,
Okay.
Adam, appreciate it.
Yeah, I can sense your enthusiasm and your excitement here.
Yeah, well, it's been on our plate for a little while, and went through a renegotiation of the terms. It ended up much better for us, but yeah, no, it's nice to get that across the line. It's our first cash flow royalty and our first syndication of a royalty financing, which we're excited about. We like that kind of method of growth at this stage of the company. So no, excited to get that one done.
Yeah, excellent. And so I guess from my perspective, I think the key ideas here to get across to the investors or potential investors are the royalty model, which I think you've gone through and have communicated the benefits of. The fact that you guys are getting a diversified exposure to the battery metal space, and to emphasize that these are maybe something that you didn't emphasize as much, or that investors really have to understand is a lot of these metals or battery materials are small markets, and and because they need this exponential growth, the entire marginal cost curve, the whole cost curve is going to be reset, because production has to come on that otherwise, at current prices or the prices of a few years ago would never have come on.
Yeah, well, and look, that's the crazy thing, right? I mean, I think back, and prices is the one thing I never try and push, because it's a very sticky place to be, right? You can never really predict it down to the moment that anyone ever wants. But I just saw a report by JP Morgan this morning. Long-term spodumene prices, they're resetting them at 850 a ton. I remember just a year ago we were 400, 450, and people weren't sure if that was going to hold in there. I was pretty sure things were going to move up, but that's a double just in long-term forecasting over 1 year. And so it's going to be very interesting to see. I definitely would agree with you on that point.
Yeah, I think for investors, I think you have to understand that most of the new production is going to come in at the at the higher end, or at least the top half of the cost curve, which means that for all of these commodities, sort of the minimum price over the long term that these commodities have to maintain is going to be higher 5 years from now than it was 5 years ago. So not only do we need a lot of production, but that production is going to need a higher sustaining price. And if and prices are unlikely to fall, because you've got to the production growth has to exceed the demand growth in order for the price to typically start falling below that 90 percentile of the cost curve for each individual commodity. And
well,
because they're all small markets.
Yeah, sorry, I was just gonna say all the offtake, pricing is very, these are new pricing markets too, right? I mean, most lithium prices are still set on like a 1-to-1 basis, and really across the board. I think what a lot of people don't know is a lot of these prices have already moved up quite a bit to the point where projects are very economical, like we're expecting on our manganese district. I know that a number of the groups, they finally talked to Volkswagen and figured out what they're paying right now, and it was double what they were thinking in their own heads. So it's very opaque at this point in time, or opaque. But these markets are only going to get more clear, and there's a lot more kind of impetus for that coming. But yeah, so a lot of it's already happening, and people just don't have a clear way to figure it out.
Yeah, I think the end user has no concept of basic commodity economics. That they want the world to produce twice as much nickel. The price they paid yesterday is not going to be a viable price for the next 10 or 20 years.
No, there's just not enough good projects out there. I mean, like humans have been already picking over this planet for quite a few years, and all the best stuff, all the easy stuff to find, all the easy stuff to mine, quite frankly, it's it sounds stupid, but it's mostly gone, right? I mean, you look at where a lot of new mine developments today are, and shoot, you see some that are right on the side of town, seeing ones that are under towns, right? They're drilling right up next to houses in London, on a London street that's paved. They're drilling holes there. So a lot of the easy stuff to mine has been mined, and so it's going to be, just by logic, it's going to be more expensive. That's why it's still there. And that's why it hasn't been mined yet. So it's going to be it's definitely going to be a roller coaster of different factors playing in. Very thin supply pipeline. Such big growth forecasts across all these metals. And what deposits are actually out there that we can actually mine economically. So yeah, it should be exciting.
I think in the nickel space, I don't know, I'm not sure exactly how it applies to some of the other metals that you're talking about, but at least in the nickel space, most of the growth over the last 10 years of nickel supply has been very dirty production out of Indonesia. Yeah. And if you care about the carbon footprint of what it takes to make a pound of nickel, making a pound of nickel coming out of Indonesia is 10 times the carbon footprint of making a pound of nickel coming out of Canada or Russia or Australia. for the existing deposit. So, you know, the question is, we want all this nickel, but you know, the only easy supply is dirty.
Well, you know, that's a great point. And I didn't, you know, that's another kind of factor that's going to play out. I mean, you know, not only the carbon footprint, but the social side of things. You know, you got 60% of cobalt comes out of the DRC, you know, which has its issues. You know, it is about 60% of tin out of China, 90% of, you know, manganese sulfate out of China, you know, 60+% of graphite comes out of China. You know, and so you've got a very high concentration of production currently, you know, in places where you might run into those kind of issues, you know, on the ESG side of things. So, yeah, I mean, that is also going to, you know, make them, to your point, it's going to be something that, I don't know how it all, you know, winds out, you know, in terms of, but people are going to, you know, have to make choices, you know, on what they value. And you might have to pay a higher price to you know, get that produced out of Canada. But you know, it'll be interesting to see. That'll be another interesting angle to see how that works out.
Question for you, Brendan. When you're looking at a new royalty, or I mean, picking up an existing royalty or making a new royalty, and you're thinking about the risk, you know, the sort of the jurisdiction risk. You know, to my mind, there's two different elements to that. There's the, you know, how investable and safe the jurisdiction is to the operator, and then there's how safe is the jurisdiction to the royalty holder as far as the jurisdiction upholding your royalty rights.
Yeah. So they're both important. You know, I would say that you know, typically the places where they have good frameworks for the operators, they've also got good frameworks for the royalty side of things. You know, so they tend to be kind of go hand in hand. But you know, ultimately, yeah, that's what I really like that piece of the royalty model, right? You know, it's tied to the project. You know, so essentially we're tying it to the actual metal in the ground. Whenever that metal comes out, we're going to get paid on it. But yeah, no, they're both definitely factors. You know, I would just say ultimately we might have to, you know, branch out and get a little more risky at some stage. You know, there's enough assets right now that we like in good jurisdictions that could be that, you know, domestic sources of supply. That we're not, you know, really in a big, you know, kind of keen rush to do it, but there are special places in the world, you know, like Madagascar for graphite, you know, seems to be a pretty special place for graphite. You know, graphite being, you know, kind of maybe one of the trickier metals, but, you know, largely really revolves around what kind of flake distribution and grade you have. And Madagascar is a fantastic place for that. You know, Mick Davis, he just did a big deal down there as well. Our Graph Mono royalty happens to be there as well. You know, and for tin, you know, it's kind of, there's Cornwall, UK, there's, you know, Tasmania, Australia. So there are special places on the planet where, you know, unlike anywhere else in the world, you find actual concentrations of certain metals. So, you know, it's for us, it's kind of, like I said, it's more about, we see the supply pipeline and we try and, you know, we've got a very good technical team and, you know, been in mining for a long time, looked at a lot of these projects, you know, 2, 3, 4 times. And so, you know, we're really more trying to figure out which projects actually might be that, you know, solution. And so, you know, ultimately, it does, you know, that comes into play as well, you know, I would say.
You know, I think towards the beginning of your presentation, you had some very good slides that you went through very quickly on the sort of global markets for a lot of these metals and battery materials. I don't know if I would encourage investors to look at some of those slides and examine them for each of those metals. I assume, is this the same presentation that's on your website?
Yeah, it should be. If it's not, I'll check, but we are going to be updating that within the next week to update it for these transactions. And you know, it's been a couple weeks, I think, or months since we updated this one. So, but yes, you can find our presentation on the website. And you know, look, I do kind of go by those slides a little bit quickly now, but you know, the exciting thing is like, how many times in your life can you see 2 decades of growth like this ahead? You know, and as what I consider, you know, a relatively young person in mining, there's not very many of us out there. You know, it's exciting to see, like my entire career almost was a, you know, bear market in the mining sector. You know, there's not that many people that have been paying attention to a lot of these metals. You know, it's just crazy, actually. The number of people.
I think people realize that the small size of these markets, makes them, exposes them to the exponential growth that you're talking about. Those two things go hand in hand. That's why copper's growth, from EVs is not going to be explosive, because the copper market is already, not that we're not going to use a lot of copper, but the market is already so big, that it's going to be a much slower, sort of impact on the overall copper market, in my view.
Yeah, no, for sure. I mean, like some of these metals, you're gonna have to grow production 5, 6, 7, 8 times, by a factor of 6, 7, 8 times, over the next 10, 20 years. So, it's, that average 15-year development timeline for mining, in a very thin supply pipeline and, all those different factors you mentioned, it's very hard not to see, higher prices really coming across the board, for each of these metals. So yeah, no, that's the one upside. I try not to talk too much and hint at, but we're starting to see it in reality now, and I think it's really only the beginning.
Let me shoot it back to Campbell. I know there's more questions from the audience.
All righty. Let's just check our questions. I think we've actually kind of wrapped it up, but I'll end with sort of a compliment. So,
Okay.
Nice work on revising the co-investment deal with Sprott involving the Middle Tennessee royalties you just closed. Seems to have enabled you to avoid a big capital raise and dilution at the current time, while they temporarily finance half of your planned allocation from that deal. So good on you.
Yeah, well, thank you very much. I appreciate that.
And, we had already touched, when you might do a debt deal and all that. So it's still up in the air. But anyway, we'll wait for the dust to settle here. But with that, I'm going to pass it back to you, Brandon. You're obviously extremely excited and happy today, especially. So this is exciting. And this is the first touch for me as well. So I think for a lot of people. Why don't you close us? And again, when you log out, share your feedback. We'll appreciate it. Brendan will appreciate it. And, you can get a copy of the replay in about an hour at amvestcapital.com/replays and in an email as well, and, share it with people. So, Brendan?
Yeah, no, well, perfect. I appreciate it. Thanks for putting this on today. I appreciate that, guys. Adam, Campbell. And if anybody has any further questions, follow-up questions, you can feel free to reach out to our website, reach out to the company. We're happy to answer anything that wasn't cleared up here today. And I would just say stay tuned. And, look, this is a long-term hold as far as I'm concerned. I think it's going to be an exciting, couple months, a couple years. And, really, we've got a long runway ahead of us. So stay tuned. It's going to be an exciting stock.
And I assume you've got some social media. If we Googled you on Twitter and whatever, we'd find something.
Yeah, I'm heavily on LinkedIn, and that's pretty much my prime platform. Don't do as much Twitter, but LinkedIn, yes, you can definitely look me up.
All right, take care. Goodbye, everyone.
Thank you.
Thank you. Cheers.